the flow from London into the COMEX was started by the tariff scare. And then it morphed into an arbitrage. So more and more was fed than probably would have ever gone without, the tariff scare morphing into, let's say, an arbitrage. Now, some people claim gold moved that way as well. Again, tariffs, in my opinion. And then others say, well, it was because, America was repatriating their gold, maybe repatriating their silver. Perhaps, I won't rule that out because I don't know for 100%. But what happened as far as the silver market is concerned is the COMEX is pretty much at, full to the brim as far as the amount of inventory they have in the COMEX warehouses. And that's roughly 500 million ounces.
I think that tells you that there's a huge physical shortage in the market, but that shows up in all the stats. We already know that the silver has been in deficit for 5 years now. So, you just can't continually run in a deficit in the physical market and not have it show up in the paper market. And that's what we're seeing.
The silver market is entering one of the most defining moments in modern financial history. Years of physical deficits, escalating industrial demand, and constrained mining supply have converged to create a perfect storm. Global inventories are thinning, and the paper markets, long used to suppress price discovery, are now being forced to reconcile with the realities of physical scarcity. The COMEX sits near full capacity, while India and China continue to absorb massive volumes of silver, further tightening global availability. With silver's increasing role in electrification, solar, and advanced technologies, it's no longer just a precious metal. It's a strategic resource critical to the energy transition. Keithneumeyer, founder of one of the world's top primary silver producers, and David Morgan, a longtime precious metals analyst, both point to an unavoidable outcome: price revaluation. Silver has been running a 5-year supply deficit of up to 250 million ounces annually, an imbalance that can't persist. As nations move to secure critical minerals and as Western investors remain distracted, a tectonic shift is unfolding quietly in the East. When this market turns, it won't move slowly. It will reprice violently as shortages collide with rising global demand. The groundwork is already in place for triple-digit silver and a generational wealth transfer toward those who hold it. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
We've seen, the paper prices come to the mercy of the physical market. And, we trade somewhere around 2 billion ounces of silver per day between London and Shanghai and Chicago. That's a lot of silver in one day to trade, considering the miners only produce, around 850 million ounces a year. So, that's pretty crazy leverage. So, all of a sudden, the paper market gets untwinged or whatever, however you want to say it. All of a sudden, they have to get the metal because they need some metal to back up all their paper contracts. And it's not the only time we've seen it. We've seen it in the nickel market previously. We've seen it in other markets as well. And we saw it in the silver market. We saw it in the silver market in 2011. I remember when, that whole move from, low 40s to almost 50, that was all short covering. We didn't see a huge short cover this time around. It was more physically driven this time around, which is interesting. I think that tells you that there's a huge physical shortage in the market, but that shows up in all the stats. We already know that the silver has been in deficit for 5 years now. So, you just can't continually run in a deficit in the physical market and not have it show up in the paper market. And that's what we're seeing.
I'm glad you mentioned that. I mean, do you have any numbers offhand of how big that shortage is, Keith?
Well, the numbers, if you go back 5 years, the numbers we all use are the Silver Institute numbers, and whether they're how accurate they are, people can have their own opinions on that. But the number fluctuates between 150 and 250 million ounces a year of physical shortages, and that's been going on consistently for the last 5 years, as I said. Doesn't look like this year's any different. Doesn't look like next year's going to be any different. Like, where's the silver going to come from? As a human race, if we're going to be consuming 1.2 to 1.4 billion ounces of silver in industry, well, that's including investment as well. including ETFs. But how can the miners ever fill that deficit? It's just not going to happen in this current price environment. Silver is a bit of a clunky metal, so it's hard to move around. And there was a lot of metal, gold, and silver moved to the United States as a result of the tariff issues. And I guess in hindsight, maybe some of that metal shouldn't have moved, but in fact, it had to move back. So the London market is really where all the price fixing occurs, and it's a market that needs that metal, and it was obviously very stressed, and they needed the metal back. And I saw some stats just I think yesterday that India was a huge consumer of silver this past month, and we know China is now. I just saw this morning actually that China is stopping silver deliveries outside of the country, and so we need this metal, and that's why I'm a triple-digit silver guy. I came up with that phrase back in 2011, 2012. I was the first to say it. I was criticized for almost 15 years for coming up with that phrase. I was wrong because silver went down to $12, but I didn't put a timeline on it. I will. My timeline is out in the future because I'm a long-term investor. I don't care about these daily fluctuations. It's irrelevant to me. I look at the big picture, the supply-demand fundamentals of this metal. If we're going to electrify the planet the way we want to electrify the planet, and governments are going this direction, nuclear power plants are being built all over the world now, which are huge consumers of silver. Rebuilding electrical grids or building brand new electrical grids, in places that don't have availability for electricity. Every time you move electricity around the world, you need silver. And I think that, where was the light that really changed the market? I think when the United States put silver on the critical minerals list, I think that was a pretty important signal to the market and to the big institutions. I've come up with phrases over the last 20 years of my career calling silver a strategic metal. There's no substitute for metal, or silver. I've come up with these different phrases, but for the United States government to all of a sudden say silver is critical, and that I think really changed the market a lot. I was a little surprised it happened so quickly, and it did make me nervous. I don't think parabolic moves are in anything, whether it's a stock or whether it's a commodity. It doesn't really matter. Every kind of major move like that, it tells you there's something changing in the market for sure. I think it's signaling something about the future, but it did get a little bit ahead of itself. And I was, questioning, where is the top going to be? And, I listened to all the same people you probably listen to, and, people calling for $60, $70 and so on and so forth, but no one has a crystal ball. But it had to stop, and it did stop, and then it hit close to $55, which is kind of nice to see. And, our stock was doing well. The whole mining sector was doing well. Gold's, 4,400, almost 4,500. So, the whole mining sector lit up and put a lot of smile on a lot of people's faces like myself who've, been in this bear market since, 2012, 2011, 2012. We had a bit of a blip in 2016 and another blip in 2020, but those are short-term blips. But I think things are changing now. You've got, the central banks buying gold now, and they weren't there 10 years ago. You now got the market waking up to the industrial needs for silver. So there's now a whole set of new buyers coming into the precious metals market, which didn't exist in the last bull market. And I think that what we've seen in the last 2 months is a signal of the future. Yeah, you're going to get big investors offside, whether they're long or short, anything. Doesn't matter if it's a stock. It doesn't matter if it's commodity, as I said earlier. These big hedge funds, big banks that have positions that might be offside, they're going to try to protect their book as much as possible, and they don't like losing money. So, at $55 silver, 3,450 gold, I think that took a lot of people by surprise. And I think there was a lot of traders, a lot of big funds out there that were just offside, and they had to have a correction. So, they wait for the right timing. And look, buying does get exhausted at some point. In a bull market, people just get tired, and then the buying ends. And that's what we've seen happen. It ended, and now the market needs to consolidate. And Usually when you see a parabolic move like that, to see a 15 to 20% correction is normal. We hope to see that. I think we're about 15% already as of today. Today's a great day for an interview. I see my screen is covered in red, which is unfortunate. I love talking on a green day, but
Yep.
nevertheless, we're down about 15%, and who knows where the bottom is, but it's going to settle. It'll find a level wherever that level is, and then it'll sit there for 2-3 months, and I think the bull market will resume. Well, cash flows are great. Having these, despite the fact that we've seen, silver come down a little bit, these prices are great for us. They're great for the entire mining sector. It's very encouraging to see all the juniors getting financed, because that's where we look at M&A transactions, on a regular basis. And, if the juniors aren't getting financed, then there's nothing for us to buy.
The ongoing tension between paper contracts and physical silver has once again exposed deep structural cracks within the global metals market. Recent movements from London to COMEX, sparked first by tariff fears and then by arbitrage, have highlighted the fragility of liquidity when physical demand surges. Inventories remain tight, with COMEX warehouses nearing full capacity and the registered supply at minimal levels. Beneath the surface, the real story is a widening gap between physical availability and derivative volume, as billions of ounces are traded on paper daily. At the same time, actual mine output lags far behind. When exchanges face shortages, they often step in to stabilize markets, masking the growing disconnect between price and reality. These interventions may calm volatility temporarily, but they don't solve the core problem. Each short-term fix deepens long-term distrust, particularly as history shows repeated manipulation and soft settlements where physical delivery should have occurred. Physical scarcity is tightening its grip on the paper illusion, and once actual demand overwhelms synthetic supply, the repricing will be swift and decisive. Let's get back to the interview.
The flow from London into the COMEX was started by the tariff scare. And then it morphed into an arbitrage, so more and more was fed than probably would have ever gone without, the tariff scare morphing into, let's say, an arbitrage. Now, some people claim gold moved that way as well. Again, tariffs, in my opinion. And then others say, well, it was because, America was repatriating their gold, maybe repatriating their silver. Perhaps, I won't rule that out because I don't know for 100%. But what happened as far as the silver market is concerned is the COMEX is pretty much at, full to the brim as far as the amount of inventory they have in the COMEX warehouses. And that's roughly 500 million ounces. Now, there's two categories, as most of your viewers or listeners know, eligible and registered. Eligible is long-term investors. It has to have a medallion. It has to be signed in order to move into the register and be sold. So most of it's just resting there, storing their silver, storing it at a COMEX warehouse. But the registered has been as low as 30 million ounces a few times, and that's always kind of perked me up. Like, that's not much inventory that's readily available in commercial bars to meet the market demand. Even though it's only a small percentage of the derivatives market, it's still there. And so, as we've seen, there's more and more demand coming out of the COMEX for physical delivery, but nonetheless, we have a pretty good inventory in the registered category for silver at the COMEX. Well, now what's happened is there's a demand coming out of the LBMA, and it's an association, not an exchange, which is a difference. You can look it up, but basically they still have to produce physical silver. And now they're short, meaning short as in the forwards that they do, which are like futures, but they're not an exchange. So point being that they need the metal, they need it now. So they're willing to pay a premium to get it. That looks like it has subsided somewhat. As far as we know, public data, 29 million ounces is shipped over from New York back to London, and the market has calmed down, but yet it looks like it's at that trigger point again, or could be soon. There's a couple of things. The lease rates have backed off. The spread between the spot market and a futures delivery, or a forward, as it's called in the LBMA, is still there, but it's in the pennies, not in the dollars. So the best I can determine, it's quelled, it's calmed down. It maybe hasn't been completely satisfied, but it looks like it may. And there are others that say that there's a delay, meaning that some of the silver that has calmed the market down in physical form has been leased. And the lease is a short lease time, like a 3-month time frame. And within that 3 months, that silver needs to go back to purportedly from China. I'm not saying it is or isn't. I'm saying I don't know for a fact. I try to be, my engineer in me is always trying to be fact. But some of the stuff you don't have facts. You've got, circumstantial evidence, as they would say. But that makes sense to me. That could be that situation. What I do know is the setup as far as the amount of percentage to go into a squeeze again is high. It's not like a very low probability. It's a rather high probability, but it's not guaranteed, obviously. So kind of long-winded, but I think, you asked a question, being in here, I'm going to paint you as accurate a picture as I possibly can. But the silver market and the platinum market are both kind of hanging on how much demand there is for physical and how quickly it can be delivered and how quickly it could be delivered in the right place. See, when the physical takes control of the market price, in almost every case I can recall, it's obvious. I mean, no one can deny it. The problem with me is that it gets settled either in the paper side or the exchange itself will take over and make the determination, even though I have to look at the contract. I was going to say, even though they really at contract weren't allowed to do so, I won't make that statement. I have to double check. But it's interesting when things get really tight, the exchange steps in, like in the Hunt Brothers, like what happened in palladium, what happened in the nickel market. It's like, dang it, here's the contract and you're not obeying it. Why not? Of course, it's probably a weasel clause or under force majeure or these conditions. We can do whatever we say we want to do in order to quiet down the market. And I'm going to go a step further here. I'm going to do it on my weekly update this week, if I remember. But a lot of these holding metal for accounts that have been proven to be otherwise. There was one with Morgan Stanley, and I can prove it. I've got it on my desktop here. And these people get punished with paper, but they should be punished with silver. In other words, if I've supposedly stored all this silver for my client base, and I never even had a vault, and I charged them for storage, which is what happened in this case. When that comes to court, it shouldn't be settled for, it's this price of silver, because people buy silver and gold to not have paper. So why should they be able to settle in paper? And the second point is, why don't they treat the people that have done wrong the same way that the Hunt brothers were treated? The Hunt brothers were basically expelled from ever trading silver again for the rest of their lives. So now these entities that have been fined again and again and again, some not spoofing, I'm talking about putting silver in a vault and saying it's there and never having any silver and never having a vault. Why aren't they expelled from having silver? No, one of these is now recommending a 20% weighting in silver. Well, are you going to trust them again to buy the silver and vault it for you? So I'm going to make a video on that. But I get a little agitated because my big picture is to be, to teach and empower people to understand the benefits of an honest monetary system, honest. And if the whole thing about gold and silver is honest money, and it's not the only thing, and it's kind of, one of my tenets, and not for everybody. Some look at it as investments, some look at it as insurance. I don't care how you look at it. My point being, if there's not honesty in any of the financial markets, especially the one that purports to be outside the system and protection, and the most of this is being moved around like that, it's very, very disheartening. And yet it's happened again and again and again. It'll probably happen again in the future.
What's unfolding now in the silver market represents more than just another price correction. It's the slow unraveling of a deeply imbalanced system. For years, the paper market has dictated value through synthetic volume, but the real engine has always been physical demand. That demand is now roaring back, driven by industrial needs, national stockpiling, and a growing recognition that silver's supply deficit is structural, not cyclical. This is no longer about traders hedging futures. It's about the world's capacity to meet absolute delivery obligations in a tightening global market. Each cycle of intervention, each attempt to calm volatility, depleted registered inventories, lease rates fluctuating wildly, and exchanges forced into emergency measures to maintain confidence. This is how monetary transitions begin, not with sudden collapse, but with creeping disbelief. Silver's role as both a commodity and a monetary asset makes it central to the next phase of financial revaluation. When faith in paper erodes, the actual value of tangible assets rises to meet reality. The shift is already underway, and those paying attention can see where it leads. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.